Bloomberg Audio Studios. Podcasts, radio, news.
The Stock Movers Podcast. This is your roundup of companies making news on Wall Street and beyond, harnessing the power of Bloomberg data.
Now let's look at some stocks on the move today in Europe. We're joined by Bloomberg's Markets Today editor Sam Unstead. Good morning, Sam. So Heathrow, it's closing for the entire day until midnight tonight. The market reaction to this?
So the main market reaction we're seeing is in IAG shares. So IAG, the owner of British Airways, Heathrow, their home base. So it's a very major disruption. Remember, they also own Iberia, Aer Lingus, and a couple of budget airlines as well. So it's a really significant disruption for them. In terms of the other market reaction, actually, has been relatively small, and there's a little bit of EasyJet's moved, TUI's moved. But with IAG in particular, Jeffrey's out this morning saying that the earnings for IAG may well take a hit, 1 to 3%, because of compensation costs. Because often, even though you could probably make a pretty strong argument, this is not necessarily the airline's fault that this is happening, they tend to bear the brunt of those compensation costs, and that could hit their earnings. And for IAG, been on a very good run, and at the start of this year, that's been dented a bit, and this is another dent in their armour.
Yeah, indeed, and it's worth remembering that it's not just the flights that are to and from London, it's the connections. It's a huge part of their business as well, right. Which is why the airline network for that company is particularly vulnerable to disruptions at Heathrow. Let's turn next to a share in Germany, the perfume maker Douglas. What's going on there? Yeah,
quite a hefty drop there. So they were down, as I got up from my desk, about 20%, down to half their IPO price now. So it's actually a relatively recent IPO in Germany and has not been performing particularly well. Most of that is down to a consumer slowdown in France and Germany, their two key markets. And yeah, their shares are under an enormous amount of pressure. And as I say, in particular, this is one of the companies that when they listed, this was held up as an example of a little bit of a bounce back in European IPOs. It was quite a significant IPO. I think it was about 8 billion euros they were valued at when they first listed. They're at about half that now. So not a great story for Germany's consumer market there.
Okay, it's Friday. Let's talk pubs. Shall we? How is Wetherspoon's doing in terms of the rising labour costs? Because we're in March, the increase in minimum wage is going to come into force at the beginning of April. This was announced in October, so companies have had some time to think about it, maybe to plan for it. But It is obviously those industries where they have perhaps minimum wage workers the most that will be affected badly. What about Wetherspoons?
Yeah, and quite a significant effect for them. So very labour-intensive industry, right? So costs are going up kind of across the whole industry. But Wetherspoons, remember, operates at the cheaper end of the market, right? So they tend to operate at lower margins than some of the pubs that more premium pubs. They have a statement in there today: £60 million of extra costs. So not just the national living wage, but also the employer's national insurance contributions as well. That translates for them to £1,500 per week per pub. So it's quite a significant increase in costs for them, and that is likely to weigh on their margins, and more so for them, as I say, because they operate at that lower price point. And so consumer weakening there, a big squeeze on Wetherspoons.
And this was coming after what was quite a strong festive season, end of year season for pub groups in the UK, and that had led, I was just looking at HSBC being reasonably bullish on pubs in a note they put out last month, because the sales were good, but now it's the costs that are coming into focus.
Yeah, well I think actually even in Wetherspoons' report today, so the main focus and the reason their shares are down, and I think they've dropped when I got up about 12%, is actually hitting a 2-year low. For them in particular, offsetting it becomes much more difficult because they operate at that lower price point, right? Their margins are the focus today, but actually their sales too have picked up a bit. So from the first half over the course of the last sort of 8 to 10 weeks, like-for-like sales growth has actually increased a little bit. So sales are going very well, and that's probably the same across the industry. But for Wetherspoons, the margins are becoming a much bigger concern.
The Stock Movers Podcast from Bloomberg Radio. Check back with us throughout the day for the latest roundup of companies making news on Wall Street. And for the latest market-moving headlines, listen to Bloomberg Radio live. Catch us on YouTube, Bloomberg.com, and on Apple CarPlay and Android Auto with the Bloomberg Business app.